Well, the initial sort of preconception that people have when they think about co-ops and investments is that they're liable for the risk of the co-op, which is true, and which is not necessarily present in the same form in a typical business. So when you're hired as an employee, there's no required capital contribution. You don't have to put any of your money at risk. And you're also not an owner in that sense. You have no control over your business. Whereas in a worker cooperative, you do have to put in capital, sometimes a substantial amount, and this capital is at risk. And this is part of what we mean by worker ownership. And this simply just has to be a change in the perceptions of what's viewed as a real job, what real ownership and real responsibility mean. And I think as a movement for worker cooperatives, this is one of the educational barriers that we have to overcome, to say that there is real responsibility here, and this should be embraced because we believe in democracy and worker ownership. And if you really believe in democracy and you believe in workers having a real say over how their business is run and managed, there has to be responsibility attached to that. And that responsibility is bearing responsibility for any profits or losses that might result. So there are also advantages to this that come with the responsibility. Mainly, you don't take the risk of your job getting outsourced, unless of course you vote to do this. You retain control of how your working life, and you get to control the decisions of the co-op. So there is actually a lot more security attached to working at a worker cooperative, even though there is this capital contribution that you're required to make. So I think it's a mistake to analyze it simply as you're required to put up this capital, which is at risk in a worker cooperative. You have to look at the whole picture of the stability of your job and the whole income stream, and also the profits that you would appropriate too if you're a member of a worker cooperative. And in the broader picture, the conventional wisdom these days is that you throw your money into the stock market and this is your retirement. And this is in fact much more risky in many ways than investing in your own co-op, which you have control over. And let me back up and explain the sort of main difference between a worker-owned business and a conventional corporation. In a worker-owned business, the value of the business is the book value, or the net asset value. The net asset value is basically the value of the assets minus the value of the liabilities. That is your net asset value. The book value is also the assets minus liabilities, but according to generally accepted accounting principles. And in many cases, they should be roughly similar. When you invest in a worker cooperative, you own a piece of those net assets. And that's true whether you're a preferred equity holder or a member who has an ownership stake in the co-op. When you invest in a stock of a company, you're investing in two things. One, you have part of the net asset value, but stock prices don't reflect the net asset value. They reflect the market value of a firm. And that market value is determined primarily on the future cash flow, the future profits of the company, discounted to their present value. So this is what every econ and finance student learns in school, is that the value of security, in particular common shares or equity of a business, is equal to this discounted cash flow of future profits. This stream of money may or may not arise, but you're paying for that up front in the present when you buy shares of a typical corporation in the stock market. So you have this risk, which is essentially the entire goodwill of the company. It's what you consider assets that you're paying for in the present that aren't reflected as part of the net asset value. So there's this tremendous risk for people who invest in the stock market, mostly which they don't see, and it's all based on the assumption that somebody's going to perceive future profits being higher than they were today, and thus pay a higher price, and isn't reflected in any real assets, so to speak. The easy way to see this is that if you're starting a business, you can have assets on your balance sheet, you can have liabilities. What you can't do is you can't say, oh, I have all these future expected revenue, all this future expected revenue we're going to get. We're going to call that goodwill an asset on our balance sheet and place this big asset on your balance sheet from all the future expected profits. This is not permitted. So what happens is that in practice, the accounting is a little bit bipolar about this. For example, if you're a business and you acquire another business, you don't acquire it at the book value or the net asset value. You pay the market value. And the market value has this goodwill component in it. So suddenly you can, in those senses, get assets on your balance sheet in the form of goodwill, an intangible asset. So that's one of the ways it can happen. The issue with AIG and some of the financial companies was that they were booking mortgage revenue for the term of the mortgage in the present because they had insurance on that mortgage. So through some accounting tricks, they were able to book current revenue that was really strung out over 30 years due to some inconsistencies within the regulations. But that's a different topic. Several ways worker cooperatives get financing. The first way is through their members. So most members, when they join a cooperative, are required to put in some capital contribution. And this goes into something called an internal capital account. Basically, it's an account that the cooperative holds in the member's name, but the funds are used by the cooperative. So, for example, when you join some worker cooperative, you may be required to put in $5,000. But of course, this number can vary depending on the co-op. And this capital is used to fund the cooperative's operations and provide working capital for the cooperative. So that's the first way. The second way a cooperative gets capital is through retained earnings. So the earnings of a worker cooperative all go to the members of that cooperative. These earnings are often reinvested in the cooperative. And so, for example, if there are earnings for some year, each of the members might be required to put those earnings back into the cooperatives for a certain period of time, say 5 years. Then after that time, those earnings would be paid back out to the member. And this does two things. One, it gives the co-ops a way to retain extra capital. And two, it prevents the capital that each member is owed from building up. So, for example, after, say, a whole career at a cooperative, since the earnings are paid out on a rolling basis, a single member won't have such a huge amount of capital stored in the cooperative that the co-op might have to demutualize or have trouble somehow paying out that capital to the member. So the basic setup of a co-op is this system of internal capital accounts where the internal capital account is the member buy-in plus retained earnings, often paid out on a rolling basis. There's a second component of the assets, which is often called a collective reserve account. And these are earnings that are retained by the cooperative, but not held in the member's name, so they become permanent equity of the cooperative. And this pool is built up for sort of a rainy day fund. It's assets of the cooperative where there's no attached liability, whereas the internal capital accounts are a liability of the cooperative. The collective reserve account is not a liability. So if a co-op is starting up, say, that doesn't need a lot of assets, basically they set up one with only member capital contributions if that's possible. If not, they might supplement it with loans, either from friends or financial institutions. Or the third option is that, and this is usually for larger, more capital-intensive cooperatives, is a preferred equity offering, where preferred equity here is a non-voting fixed value share that provides the investor with a fixed return, so a fixed dividend payment in this sense. And co-ops would issue preferred equity to leverage it because preferred equity is subordinate. That can be leveraged to get loans from banks. So for a worker cooperative, preferred equity is different than preferred equity for a conventional business. In a conventional business, preferred equity can be converted to common shares, which have voting and controlling power. And this is not the case for worker cooperatives. So even though it's called equity, this equity has no control over the co-op, so to speak. It's effectively subordinate debt, or in other countries, what people would call a perpetual bond. In the case of worker cooperatives, what banks care about or financial institutions care about is where their loan or their investment lies with respect to the other investments. So if there are losses in a worker cooperative, members are always the first to bear those losses. And that's part of the principle of worker ownership, that if there are profits or losses, those are the workers' responsibility. And the workers bear those losses through deductions from their internal capital account, or if they have gains, those are credited to their internal capital account or the collective reserve account. So the internal capital account plus the collective reserve account take the first losses that any worker cooperative may incur. In the case that capital is wiped out, then the preferred equity holders would take losses. And usually the last group to take losses are the financial institutions, the banks or credit unions. So that would be called senior debt. It's the last to take any losses. And the member capital from the members of the worker cooperative is the subordinate debt. That's the most junior debt and the first to take all losses. And the preferred equity investors are in between.